So welcome everybody to today's podcast. Today we're going to talk with the authors of an article that they recently penned that will be appearing in this year's pre-edition of the Journal of Portfolio Management. The title of the article is, "Do Non-Traditional Property Sectors Reduce Risk in a Core Real Estate Fund?" So joining me on the podcast are two of the authors, Mark Fitzgerald, Managing Director and Global Head of Research for Affinius Capital, which is formerly known as USAA Real Estate Advisors, and Jeff Fisher, who's the president of the Homer Hoyt Institute and academic research advisor to NCREIF. I should note that Will McIntosh, the founder of ArcBridge Research Group and the author of the article along with Mark and Jeff, was unable to join today's call. ArcBridge is an independent research and consulting firm focusing on real estate infrastructure and the real asset classes. Anyway, welcome, Jeff. Welcome, Mark. First question for you two is, what in the world motivated you to explore the role of non-traditional property in core real estate funds?
Well, first off, Jeff, thanks for having us and excited to be here. In terms of what motivated us, I think part of it was certainly what we see as non-traditional or niche strategies that continue to gain mind share for investors and for the investment community in the real estate space. And I think as the overall institutional real estate business has continued to grow, these non-traditional sectors have experienced a fair amount of success. So one of the things we touch on early in the paper is looking to the publicly traded REIT sector, where firms have had have more of a single sector focus. There has long been an increased and a heightened focus on some of these alternative sectors. If you look as of today, where market capitalization sits across the public REIT space, only about 40% of the 1.4 trillion market cap for U.S. public REITs is in what we would consider the 5 traditional sectors of apartment, office, industrial, retail, and hospitality. The rest is across these other spaces, including things like data center and self-storage, senior housing, medical office, et cetera. So we wrote a paper on this topic actually for this same journal back in 2017 that was initially exploring some of the growth in allocation and the performance of the non-traditional space. It has increased by 3 times that for the NCREIF index for private real estate investors since that time. And Jeff and I have been attending a lot of the NCREIF meetings, and something that's been brought up quite a bit is how do we capture and measure that performance, right? As these sectors are emerging, they are historically not tracked as well. There isn't third-party data on the performance of these sectors. So how can NCREIF address this? And we've had a series of task forces at NCREIF looking at how do we break out different types of subsector performance as new sectors emerge. And that was something that finally came to fruition over the last 18 to 24 months, where NCREIF is now capturing some sectors that it wasn't previously. So areas they had been capturing, like self-storage and senior housing, went from subtypes to official property sectors, and some newer strategies, data centers, as well as life science, medical office, student housing, that were previously not tracked build to rent, are now being tracked, or maybe were tracked but put into another bucket, or some people put them in the residential bucket. And so that was a change that had been made. And then we made the announcement, or NCREIF made the announcement about a year ago in terms of the allocations for Odyssey, where previously those niche sectors were scattered primarily in the other bucket, and now some of those have been moved into some of the primary categories.
So you're out talking to investors all the time. How have these changes in the NCREIF sector and subtype classifications impacted the way that investors are viewing and benchmarking their real estate portfolios today?
I mean, we're seeing more and more of these alternative sectors in core portfolios, and I think they realize that, as we'll talk about more later, they're seeing diversification benefits associated with those sectors, and it's not causing them to have lower returns, if anything, higher returns. So they fit well into core portfolios, and we wanted to really ask ourselves, okay, what are the benefits of including them in core-like portfolios?
Before we dive into that, Jeff, what do you think are the things that are driving people in the direction of these non-traditional asset classes? Why aren't they just mean, for almost centuries, it feels, certainly for several decades, there were four property types, four main food groups, and that was where everybody is investing. Now we're seeing a bigger portion of the Odyssey Fund universe, at least, and certainly on the other core property funds,
And I
including
think,
these
yeah,
non-traditional sectors.
I think they reflect structural changes in the economy, cloud computing, aging demographics, e-commerce, remote work. These are really relevant demand drivers, and people are realizing that that's impacting the returns on these alternative sectors, and those sectors look like good investments even in a core portfolio.
Yeah, I think that's exactly right. Right. If you think about the importance of the intersection of technology and real estate and what it's doing for the, not just the data center space, which is obviously getting a lot of attention today, but life science more a few years ago. And then I think Jeff mentioned, the aging of the overall population has implications for senior housing, healthcare, medical office, as well as the millennials moving into the next phase of their life and starting families and moving out to, I think, looking for more space, like all, historical demographic groups have done as they've aged. And so that's really fueling a lot of what we're seeing in the single family, residential, rental, and build to rent strategies, where, especially today with where mortgage rates sit, it's become more affordable than unaffordable than ever to actually buy a house. And so how can you, have more space, but also continue to rent? And then some of it has been, I think, some areas that just have been around for a while now and have a proven performance track record, like self-storage, which maybe had a tougher time gaining acceptance in the early stages, but given fairly stable tenancy and low cost of maintenance in that sector and low cost of capital expenditures has had strong performance over the last 20-25 years.
And we're seeing more of these alternative property sectors in the NCREIF Property Index than even hotels that have been in there since the beginning. We've got more data centers than hotels, more self-storage than hotels. So, there's clearly a shift taking place in, what investors want in their portfolios.
Now, the research they did that the paper's based upon highlights a lot of diversification benefits for including these non-traditional sectors in the portfolio. Can you explain how? I mean, how do these sectors affect risk and return in a core real estate portfolio? What does the research show?
Yeah, a key driver there would be the correlations. So you're looking for asset classes that are not highly correlated with the asset classes that you already have, and we find that they do have lower correlations. Coupled with that, though, you need to have decent returns, and they do. They have returns that are commensurate with their risk, and so the combination of the returns and the lower correlation results in them being included in what we call an efficient portfolio.
We saw the traditional, four food groups get hammered pretty hard during the post-COVID period and the rising interest rate environment that followed. How did these sectors hold up during that period of time?
They held up quite well. Some of them never even had negative returns. They certainly held up as well as the traditional four, or if you want to include hotels, five food groups that we've traditionally had.
And which would you say stood out as particularly beneficial for diversification or performance?
I think some of the ones that have particularly stood out more recently, obviously, there's less of a historical track record of data centers. And I think the nature of what data centers are today, what's being developed for the hyperscalers, is a little bit different than some of the older portfolio, but those tend to be holding up very well. And I think have, as you can see from some of the capital expenditures in the space and the investment activity directed there, have held up well despite some weakness in the economy. We've also seen that with the medical office and senior housing space more recently as well, which has rebounded nicely since COVID. I think other sectors have been disproportionately impacted with different demand drivers, and life science certainly comes to mind in terms of something that has a high exposure to the venture capital space. And when the capital markets saw some weakness beginning in 2022, that's a space that's really struggled in the last couple of years.
Could you walk us through your research methodology for this article? How did you construct and compare the different portfolios?
Yeah, I think what we tried to do was to isolate. So with the new Odyssey definitions, the apartment definition has been changed, or sector has been changed to residential, and now apartment build to rent, single family rental strategies, manufactured housing, and student housing all fall under that category. So that's an example where we really tried to isolate sort of the traditional sector of apartment versus those three new sectors. And the current or the new rules for Odyssey are that still 75% of the portfolio has to be in the traditional four buckets of residential, office, retail, and industrial. But these subsectors can take up a 25% allocation, so a third of that 75% bucket. And then there's also the ability to get up to 25% of other. So the way we structured it was to break out those four traditional sectors only with the traditional subtypes: apartment, industrial, office, and retail, and then have an allocation for, call it, alternatives or non-traditional sectors that fall under those big four, which would include build to rent, student housing, manufactured housing, life science, both for office and industrial and medical office, and then the other category, which is everything from data center, self-storage, senior housing, parking, et cetera. So 6 buckets, sort of the 4 major sectors, other that falls under the traditional bucket or the traditional major sectors, and then other that does not. So we group those together. Part of the reason to group the other sectors together is we just have in some of the subsectors a very short history and a pretty thin sample size relative to some of the major sectors, and that was one of the reasons to structure it that way. So then looked at the historical data set going back 20 years across all of those categories and their correlation relationships. I think one of the things that was really interesting that you referenced earlier was in terms of correlation and diversification. The individual non-traditional sectors do seem to provide fairly low correlations to many traditional sectors and a fair amount of diversification. When you aggregate them up, there's actually a pretty high correlation between non-traditional and traditional at the portfolio level.
You mentioned a rule, Mark, in terms of what is required to qualify as an Odyssey fund. And despite that, investors have continually been whittling down their office exposure. Do you see that rule shifting and changing at all, or do you think it's going to hold steady?
I mean, I think the nature of what's happening in the industry is going to drive how the future rules. I think really what we saw was an increased shift toward these sectors and a look to capture the performance and measure the performance. And that's really what drove, I think, a lot of the changes in the task forces that were implemented with NCREIF. And, I expect that to continue. I think Jeff referenced it earlier, right? We continue to see new sectors emerge, industrial outdoor storage and others. So I'm guessing that these niche sectors will take up an increased space and there'll be new sectors emerging as well. So expect that evolution to continue. I think what we do see within the office portfolio and have seen for the last several years is a shift towards some of the, non-traditional subsectors of office. The medical office and life science are taking up a much larger percentage of the overall Odyssey office bucket today than they were 5 or 10 years ago.
You do have to be careful by considering all offices the same. The better performing office is doing fairly well. It's just the rest of it that's not doing too well in the last couple of years.
Yeah, we're seeing a bifurcated market for sure. So what were some of the biggest challenges you both faced in analyzing the performance data for each of these emerging sectors? Jeff, you want to go on that?
As Mark said, we took kind of a portfolio approach because we didn't have a long history on some of the alternatives. And so we took the approach of, what are the traditional four, and then, what's allowed in Odyssey that are in the traditional four, but new subsectors, and then what are outside the traditional four. So we basically built 6 different portfolios and asked ourselves, would those portfolios be included in the index? As more and more data is available in the future, we'll be able to look more deeply at some of these things, but we were kind of limited by the amount of data on some of the subtypes.
So managing non-traditional sectors often requires specialized expertise. As a matter of fact, there's been increasingly, I'm hearing the word operational real estate creep into the dialogue when people are talking about drivers of performance. So what are some of the operational challenges that investors should be aware of that their managers are facing in managing these kind of specialized assets?
Yeah, I think there are, I think choosing the right partners is going to be incredibly important across the industry, but also particularly for some of the diversified core vehicles where they, are not going to have the in-house expertise or track record necessarily going back. So how can you, if you're looking at something like a self-storage or a net lease business, not just find the right operating partner, but also scale the business in an efficient fashion, because those tend to be smaller deal sizes. And then in terms of running the business, I think we see, senior housing is probably a great example. There's a spectrum there across independent living, assisted living, nursing care. So how do you find the right partner for the right type of medical care? And how do you focus on, what is their experience, track record, and operational philosophy? Because many times, that is not something that's going to be efficient for private managers, and particularly for diversified funds or diversified managers to have in-house. So how do you find that right? And what are you bringing to the table, right? In terms of the expertise, in terms of the capital, et cetera.
So most of these specialized assets are reflected in both the private markets and in the public markets. So how would you characterize any differences between the way that the public REITs approach their ability to manage these alternative assets versus the way in which private core managers approach them?
Yeah, I think they tend to believe, or probably have, since they're single sector focused, they would tend to have more of that expertise in-house. I think that where there's some differences are, so where there may be more partnerships in the private space, or even sometimes partnerships with the public REITs, right? I think they tend to be penalized for having value creation or development strategies on the books. And that's often an opportunity for private managers to partner with the REITs or to exploit at certain points in the cycle the ability to create some of these core properties via development or repositioning. So,
Prologis, just to single out a particular REIT, has tended to tap the public and the private markets, probably more so than most REITs. And they've been really successful in raising money in the private markets as well as in the public. Do you see any other REITs moving in that direction?
Yeah, I think we have seen that more recently with some of the net lease REITs as well that are beginning to move in that direction. So it does seem to be somewhat of a trend that they're seeing the opportunity for the right capital for the right deals.
And what are the most important findings from your analysis for institutional investors considering investing in these non-traditional sectors?
Including the alternatives improves portfolio efficiency. You're getting equal or better returns and lower levels of risk. And I think an important point to make is that some of these sectors might be considered non-core assets, but including these non-core assets into core portfolios can actually reduce the risk. So you can have a non-core asset in a core portfolio and actually reduce the risk of the core portfolio.
Interesting.
Yeah, I think like you referenced, Jeff, the different demand drivers that we see for some of these sectors provide some diversification. And if we looked at utilizing the Odyssey rules in terms of a minimum of 3 property sectors, a maximum of 60% to any individual, and minimum of 3 with 5% allocation, and use those 6 portfolios that we referenced earlier, what we found is that these alternative sectors, both within and outside of the core 4 sector, what we found is an additional, it would kind of increase the potential return in the optimized portfolio by about 80 basis points.
Wow,
as well.
That's pretty significant.
Yeah.
Did anything surprise you in the results, especially regarding volatility, returns, or correlations?
I think we expected the correlations to help. I think what surprised us is the returns were also quite good.
Yes.
So we weren't giving up return in order to get the diversification benefits.
Yeah.
Interesting.
I was surprised too, the volatility I thought might be higher than what we see in the traditional sectors, given less established sectors and smaller sample sizes, shorter histories. But we really didn't see that much through the alternative portfolios. The overall volatility was very favorable or similar compared to your traditional property types.
So what do you see as the main limitations of your study, and how should listeners interpret your conclusions in light of those?
Reviewers always ask in articles like this is, are there fat tails? And does that invalidate your research in some way? And the way I looked at it is, yeah, there may be some fat tails in real estate, but are the tails any fatter by including these alternative sectors? And I don't think we found that to be true. So we weren't adding any risk by adding these sectors. There's fat tails, there always were, and there still are some fat tails, but that certainly doesn't invalidate the results. It just makes you want to dig a little bit deeper, maybe in some cases, to see if there's some additional risk and additional risk measures you'd want to look at.
Yeah.
For those of us who took statistics 50 years ago and haven't done much time with it since, can you explain the implication or the significance of fat tail?
That just means your returns could be higher or could be lower than what would be predicted by a more normal type of distribution. Where you say 68% has to be within one standard deviation and 95% are within two standard deviations. Well, they're maybe a lot more than 95% at either end of the tail. And during periods when returns are really bad, that could mean all the assets tend to move together when things are bad. So the correlations may be, we may be understating how correlated they are during really bad times, but I think for most of the history of the index, we're pretty well capturing what's going on.
Yeah, I think if we want to go back to your statistics class, Jeff, is one of the other things that we're seeing is, we ran portfolio optimization using mean variance analysis for this exercise. That is has a couple of limitations. I think if we had richer data sets that Jeff referenced earlier and longer time series, we could look more at value at risk and downside deviations and peak to trough kinds of analysis. But given the limited data sets, we ran that, so there may be a little bit there. And then I think the other major limitation or challenge that a reviewer could have for our analysis, in addition to what Jeff said about fat tails, is when we're combining the alternatives into a single portfolio, given, to your point, the operational expertise necessary, it's unlikely that probably most core managers or most core funds, I should say, would have the ability to invest across all the different types of alternatives. They would probably have to choose a select through if they had some operational capabilities of the right partners. And therefore, framing it as having an entire diversified portfolio of alternatives may be overly simplistic for the analysis.
So what areas of this research do you see as most promising for future research as more robust data does become available?
I like the idea of looking at more downside risk measures. Several years ago, one of the members of NCREIF asked me if we could calculate a Sortino ratio with the NCREIF data. I had to go back and see what the heck a Sortino ratio was, which is kind of like a standard deviation, which you use just a measure of the downside returns in your denominator. Your standard deviation is just of the downside returns. And as we get more data, I think we can start to look at some of those other measures. Mark kind of alluded to this, that maybe we need to look more at downside risk measures and other measures of risk in addition to just the risks that drive the portfolio theory.
Yeah, ideally we'll get some more, the data sets will get richer as well. And so as we have more data, maybe we can do a better job of breaking down student housing into on versus off campus, or breaking down the single family residential strategies into build to rent versus single family rental aggregation. And so just get deeper and deeper into, again, establishing niches within the niche sectors probably.
So for investors or fund managers listening today, what practical steps would you recommend if they want to start integrating non-traditional sectors into their portfolios?
Find a good partner, right?
Well, we talked about that, but what else besides find a good partner?
I think it's really one would be evaluating, the partnerships that Jeff mentioned. Where can you bring value to the table? And also, we've seen some of these sectors outperform. I think what you probably will see over the longer term is, when non-traditional sectors enter the fray, they are priced differently because there's less of a track record and investors aren't comfortable with it. So they may have higher cap rates and those cap rate spreads may begin to compress over time. And that provides outperformance for some of these sectors as they initially become more accepted. And then it's really looking at the macro tailwinds and where do you have conviction that certain sectors will continue to outperform, or maybe some of those sectors are played out or will perform more like a beta play or more like traditional sectors as opposed to what they provide in terms of differentiation historically.
Are there any other pitfalls or misconceptions you'd caution against?
I think one would certainly be, be very careful about entering new sectors that may be hot sectors or markets, but if you don't have the right partners or the right expertise, it can be challenging to get the right deal flow and see the right deals.
Yeah.
Yeah, I've heard some concerns about data centers, for example, because the technology is changing so quickly. What's the data center going to look like in the future compared to what it looks like now?
Yeah, that's there was an article actually in the Property Chronicles this week of their magazine talking about that. It was kind of interesting. They were comparing it to the railroads and how even though the business community and individual consumer community benefited immensely by the introduction of the railroads, it was really bifurcated in terms of which investors really profited because there were a lot of pitfalls along the way that people didn't anticipate.
Yeah, I think we see that in the data center space, specifically with our partners and our vertically integrated development team, right? They have to work very closely, and the requirements from the hyperscalers in terms of the power needs, et cetera, are changing very rapidly.
So how do you see the role of these non-traditional property sectors evolving over the next decade?
I think we see a continued demand from investors to demonstrate, even when we're looking at traditional sectors, right? It's like, how can you prove that you are going to continue to provide us with alpha and to outperform the index? And so whether that's targeting a certain geography or a certain part of the market, and obviously today we hear a big need in the marketplace given what's happened in terms of affordability for more affordable or workforce housing strategies. And so I think we expect to see, like we talked about with industrial outdoor storage and other sectors, new sectors emerging, probably a much more granular breakdown within some of these sectors to understand different, strategies and more pointed strategies within some of the subsectors. So that's, we expect that evolution, I think, will just continue like it always has.
Yeah, unless correlations change, yeah, we should expect continued interest in investing in them for diversification benefits. Even if you're not earning alpha, you're still getting the diversification benefits. So you're getting a lower risk at any target rate of return.
So is there anything we didn't talk about that we should have talked about that's important out of your paper?
I think we hit on most of the major themes. I don't know, Jeff, what are we missing?
Can't think of anything.
Right.
Okay. So if you're going to try to leave our listeners with one key takeaway to think about, what would it be?
Non-traditional sectors are no longer niche.
Interesting.
Yeah.
Anything to add to that, Mark?
No, I think need to continue to stay on the pulse of how these sectors are evolving, and really, I think where these non-traditional sectors have really been able to capitalize and outperform is capturing those demographic or technological trends that are evolving, and being able to be at the forefront of that as it emerges can really add to the performance of a portfolio.
Okay, well, thank you guys for joining us. Listen, if you've been listening in and you're interested in this topic, I really encourage you to get a hold of the pre-edition of the Journal of Portfolio Management. There's lots of great articles in it, and this article is just filled with good data to back up all the things we just talked about. So if you're really, truly interested in it, you're going to find it really an invaluable resource. Thanks for tuning in.
Thank you, Jeff.
Thank you, Jeff.
Take care, everybody.